Okay, let's unpack this. The extraordinary high-stakes career of Masayoshi Son, the founder of SoftBank.
Yeah.
And this is a man who, you know, despite having been one of the most powerful global power brokers and technology investors of the 21st century, is still relatively unknown.
He really is outside of certain circles.
Outside the highest echelons of finance, for sure. Over the past 2 decades, he has controlled or invested in assets valued at well over $1 trillion.
A trillion.
That scale of financial impact is it's stunning, making him arguably the most consequential mogul alive who isn't, a household name.
It's a truly fascinating case study because Masa Son's trajectory is a perfect mirror for our current era. It's this dizzying blend of technological optimism, rapid globalization,
Sure.
and an absolutely borderless finance.
He embodies this intense paradox, doesn't he?
He really does. A deeply felt humility that's rooted in his upbringing, combined with a staggering, almost unbelievable hubris when it comes to risk.
Yeah, his career is not a slow climb. It's an extreme roller coaster.
Totally. It's defined by these massive, world-changing successes that are then followed by equally crushing near-death experiences for his company.
He's the ultimate risk taker.
Precisely. His entire operating philosophy is defined by his willingness to bet everything. I don't just mean bet big, I mean everything on what he sees as the inevitable technological future.
It reminds me of that Jack London quote you mentioned.
Yes, from Burning Daylight. He risked everything for everything, and anything less than everything meant that he was a loser.
Wow.
And to understand Masa, you have to accept that ethos. Anything less than winning the whole game is, in his mind, failure.
So our mission today is to trace that incredible journey. We're going to track his rise from poverty in post-war Japan all the way through to the creation of the $100 billion Vision Fund.
And try to decipher what really drives this audacious, relentless risk-taking.
It's a psychological journey as much as a business one, isn't it?
Oh, absolutely. We need to see how his background as an outsider really allowed him to break free from the traditional constraints of Japanese corporate life.
And embrace a global vision long before his peers ever did.
Exactly. His success is built not despite his failures, but because of them.
So let's begin with those roots, because they are so foundational to who he is. Masayoshi Son was born an outsider in post-war Japan.
Right. To poverty-stricken Korean immigrants, a community that's referred to as Zainichi.
In his earliest memories, they paint a picture of just severe hardship. He remembers the smell of pigs, the soot from steam trains near the Tosu railway station.
And growing up on a literal dirt track, that Zainichi identity is the absolute key to understanding his ambition and his unique entrepreneurial style.
He had 2 names from birth, right?
He did. Masayoshi Yasumoto, which was his Japanese name, and Sun Jungwi, his Korean name. And what's interesting is that both names mean justice.
That's a profound signal of his parents' hopes for him.
For him to overcome the intense societal hurdles they were facing, because despite speaking perfect Japanese and having a Japanese alias, he was treated as a pariah.
And the sources highlight this moment where that status became a physical reality. He's walking home from kindergarten.
And he's attacked by the local Japanese kids. They're taunting him for living in the Korean ghetto. A stone hits his forehead and draws blood.
So that physical scar became a psychological one.
Absolutely. It was a moment of absolute clarity for him. Regardless of any alias, he was an outsider. And this experience, combined with the immense sacrifice his parents made to lift the family out of poverty.
His father went from pig breeder to, a loan shark.
A pig breeder, then a loan shark, and eventually a very successful pachinko king. That sacrifice created this powerful, almost crushing sense of obligation in Masa. He felt he had to achieve something monumental to justify their struggle.
That outsider lens is so crucial. It meant he didn't feel obligated to play by the consensus-driven rules of the Japanese establishment later in his career.
Absolutely. The traditional Japanese corporate culture, it values consensus, harmony, long-term relationships, often at the expense of disruptive change.
And since Masa was already a pariah,
he had nothing to lose by rejecting those norms. He could adopt what the sources call the frontier spirit of Californian capitalism without any hesitation.
And central to this rise was the creation of his self-identity as a genius.
Yeah.
His father, Mitsunori, was the driving force behind this belief.
He promoted Masa's exceptionalism fiercely. Mitsunori's constant affirmation, even if it, bordered on delusion at times, was a calculated move.
A self-fulfilling prophecy.
It was.
Yeah.
His philosophy was basically, because Masa is convinced that he's a genius, the good ideas follow. If you truly believe you're strong, you're a genius, then failure just bounces off you.
It gave him the intellectual shield he needed to absorb these massive failures later on without internalizing them.
And we see that exceptionalism manifest really early on, right? Those anecdotes are wonderful.
Yeah, at age 8, he looks at his father's cafe and advises him to hand out free coffee vouchers to attract customers.
It's a basic marketing concept, but highly innovative for an 8-year-old in that context. And then there's the story from the 8-kilometer middle school run,
The shortcut.
where he calculated a shortcut, but then he claimed he imagined the route rather than relying on a map.
Which is why his colleagues joke that Masa's life is one long shortcut.
That's it. He visualizes the final goal, trillions in profit, owning Japan, a $1 trillion fund, and then finds the fastest, least conventional path to get there, often just ignoring the rules in the middle.
That mindset led to the first major conflict with his family and really his own identity. He originally wanted to be a grammar school teacher.
A very respected path. But he was devastated when he was told his Korean nationality barred him from the profession. He realized the system would not allow him to integrate simply through merit.
So he demands the family naturalize. But his father, Mitsunori, refuses.
He saw it as a betrayal of their Korean roots. And that identity crisis was then compounded by a trip to South Korea.
He couldn't see the language?
Couldn't speak Korean, couldn't read the characters. He wasn't Japanese, he wasn't Korean, and he certainly wasn't American yet. He was just adrift.
But instead of despair, he found motivation.
Exactly. He realized he was starting from zero, which he concluded was better than being a minus, a clean slate, ready for disruption.
And this defiance solidified when he insisted on studying in the U.S. This is a severe violation of that fundamental Korean immigrant principle.
You do not abandon the family economic entity. It was seen as incredibly irresponsible, especially since his father was seriously ill with cirrhosis of the liver at the time.
That moment is key because it showcases the essential Masayoshi son.
The need for massive disruptive change outweighs personal or familial obligations. He had to forge his own path, even if it meant breaking tradition and causing a lot of pain.
And that single-minded pursuit of global influence became the defining feature of his business life. So he makes the pivot to the U.S. He attends Holy Names in Oakland, putting himself right next to Silicon Valley, just as the personal computer revolution is taking off.
Perfect timing. And his first major business idea, really the seed of his empire, was a miniaturized voice synthesizer.
He was a conceptual genius, able to spot the market opportunity years ahead of the curve. But he needed technical help.
So he charmed Professor Forrest Moser, who Masa called a modern samurai, into developing a prototype for him.
And his business model was to put these small speech translators in airport kiosks for travelers to rent.
Yeah, targeting the emerging mass market of cheap global travel. It was prescient.
But Moser was very clear on the division of labor. He said Masa had zero knowledge of coding.
He called him a businessman with a capital B. Yet Moser was so impressed by Masa's sheer ambition that he told his wife that night, that guy is going to own Japan one day.
Masa immediately launched into business development, writing to 50 Japanese manufacturers. And the response was brutal.
Just rejection after rejection. Matsushita turned him away. Sonia refused to even take a meeting. Sharp was his absolute last chance.
And he secured a $1 million deal for the translator from Sharp. But the anecdote surrounding the deal tells us everything about the dual nature of his ascent.
It does. The need for his father's traditional influence combined with his own modern, aggressive acumen.
His father, Mitsunori, the Pachinko King, traveled 7 hours by train, bowed formally.
And introduced Masa to Dr. Tadashi Sasaki, the head of R&D at Sharp, and a genuinely legendary engineer. Sasaki took Masa under his wing and became a lifelong mentor. It was the traditional Japanese gatekeeper legitimizing the Korean outsider.
But Masa, who was still only 22, almost sank the whole deal through pure inexperience.
Oh, yeah. He entered into these unauthorized, basically non-existent deals with other Japanese companies to buy national semiconductor chips at prices he had just invented. The local distributor was furious.
It was a huge personal humiliation. He had to fly back and physically unwind these deals.
But it taught him the critical importance of written contracts and, following established rules, a lesson he would often test but never forget.
He took that lesson and used it to launch SoftBank. He returned to Japan in 1980, bringing that frontier spirit of California to a Japanese corporate environment that was, at the time, still very inwardly focused.
He started a software distribution company, sensing that the PC revolution required a completely new retail and distribution model.
And this is where we get the audacious prediction, the Tangerine Box speech of 1981.
He gathers his 2 employees, stands on a tangerine box, and declares his vision for the company's future. In 5 years, profits have to be 10 billion yen, then in 10 years, 50 billion.
Eventually, I want to count profit in trillions of yen.
His 2 employees quit days later. They thought he was insane.
Of course they did.
He moved to Tokyo undeterred and executed his first major gamble, the Osaka trade show gambit. With almost no money and no reputation, he secured the single largest booth at a major consumer electronics show.
And he offered to pay all the costs for dozens of software vendors to exhibit within his booth. It sounds like a ridiculous expense for a struggling startup.
But it was all about positioning. By controlling the largest footprint at the show, he instantly looked like the most important player in software distribution, even if he had no inventory yet.
An executive from Josh and Denki, a major retailer, saw this spectacle and contacted him.
And Masa staged a masterclass in selling potential.
What was his pitch?
He admitted he had no business experience, no product yet, but he demanded an exclusive partnership. He argued, if you want to be the #1 TC dealer in Japan, you have to find the #1 guy in software distribution. That's me.
And the retailer was completely won over by this sheer, unbridled optimism.
Signed a major deal. And that gave SoftBank the leverage it needed to dominate distribution almost overnight.
But just as SoftBank gained all this momentum in 1982, Masa was hit by a profound personal crisis.
A diagnosis of chronic hepatitis B. Doctors gave him 5 years before cirrhosis would set in. And the idea that his bank or investors might find out was terrifying.
The fear was entirely financial and existential.
It was. He believed, probably correctly, that if the banks knew their CEO was potentially dying, they would immediately pull all the funding. So he was forced to maintain this facade at all costs.
Sneaking out of the hospital for crucial meetings.
And his solution was typical Masa. He devoured scientific journals, rejected all the standard advice, and settled on this risky, counterintuitive cold turkey treatment, stopping medication to force his immune system to fight back.
He spent 2 agonizing years in recovery, and during this time, he was reading a historical novel about Ryoma Sakamoto.
The legendary samurai reformer who was assassinated at age 33. Masa felt this intense kinship with him, seeing himself as a modernizer whose revolutionary life could also be snuffed out prematurely.
This vision reinforced his sense of urgency and ambition.
So much so that he later hung a giant portrait of Sakamoto in his office as a constant reminder of his purpose.
So since he was incapacitated, he needed a stand-in CEO. He secured Yasuhiko Omori, a powerful executive from Nomura Securities, nicknamed Mr. IPO.
And Masa switched to the chairman role, but he was a little disingenuous about the title. He claimed that in the U.S., chairman is more important than the CEO, which was true in the U.S., but the exact opposite of the truth in consensus-driven Japan.
He was trying to signal that he still had overall authority, even while recovering.
Right, and the corporate elite celebrated this partnership with a massive party for 1,000 top executives, but Omori quickly became a problem.
Too old school.
Way too old school. He disdained SoftBank's startup culture, made consistently dumb decisions according to Masa, and spent extravagantly. Masa felt the loss of control keenly, proving that the only person who could successfully drive SoftBank was Masa himself.
Control was also the key motivation in his famous 1983 confrontation with Bill Gates.
Oh yeah. Gates and Microsoft had just announced the MSX standardization system, aiming to control the entire Japanese personal computing market.
And Masa, rising from his hospital bed, launched a full-scale counterattack.
He held a rival press conference, flanked himself with allies, and attacked MSX as a monopolistic system, offering a competing standard with a much lower license fee. This was an unprecedented move of public defiance in the Japanese business world.
This intense confrontation became known as the 10-Day War.
And it ended in a truce only after Microsoft lowered its license fee. It was a massive victory for Masa, proving he could go toe-to-toe with global titans and win. The press dubbed him the prodigy who sells. He wasn't just a distributor, he was a market force.
And if we connect this period to the wider financial world, Masa was proving himself right before the entire Japanese economy went into a speculative frenzy.
Exactly. The late 80s, early 90s, that was The era of the Japanese bubble. The context is crucial. After the 1985 Plaza Accord, the U.S. pressured Japan to strengthen the yen,
And Japan's response was excessive monetary easing, cheap money.
which flooded the economy and fueled massive speculation in stocks and, most critically, real estate. At its peak, the Imperial Palace grounds in Tokyo were literally valued at more than all the real estate in California.
Just a completely distorted financial environment.
And Masa witnessed the destructive end of that frenzy firsthand through his own family, which serves as a powerful cautionary tale he never forgot.
His father, Mitsunori, squandered millions.
Yeah, he tried to transition his pachinko money into the stock market. He lost a staggering $44 million in Tokyo Corporation shares, which were all tied up in messy Yakuza scandals. And the result was the seizure of family properties.
Masa had to step in and repurchase the family home in 1996.
He did, and that repurchase led to this final, brutal confrontation with his father. Masa told him straight up, "You're past it. Your business instincts don't cut it anymore."
While it's cold.
It's the ultimate cold-blooded business verdict on the man who had instilled the genius's belief in him. Yet, despite the bitterness and the financial rescue, Masa never shed the feeling that he was forever in debt to his parents' sacrifice.
That complex, dynamic ruthlessness combined with profound obligation is central to his later risk philosophy.
Absolutely.
So Masa was moving away from his national identity constraints and embracing the global stage. In 1990, he naturalized as a Japanese citizen.
But only after fighting the bureaucracy for 7 years to keep his Korean family name, Sun. That insistence on the name was a statement of family pride and ancestry. By becoming a Japanese citizen, he removed a career barrier, but by keeping the Korean name, he retained that critical outsider status.
He saw himself as the perfect gateway between Silicon Valley and Japan, a strategy built on rapid, high-volume acquisition.
And his U.S. presence just exploded during the mid-90s .com boom. He bought Ziff Publishing for $2.1 billion, which incidentally gave him a small inherited stake in a tiny startup called Yahoo. Then he bought Comdex, the enormous trade fair, for $842 million.
The Comdex purchase is pure Masa. He massively overpaid.
And sold it back later for a fraction of the price, but he didn't care about the short-term profit. He was buying status. He wanted an entree into Silicon Valley where he wasn't one of the small guys standing in a 2-hour line with a badge. He used Japanese capital to buy American status and networking access.
And the Comdex sale funded another empire builder, Sheldon Adelson, who used Masa's cash to build his casino empire.
It's this incredible chain of financial influence, and the little anecdote about the Ziff bid perfectly illustrates Masa's blend of superstition and extreme self-belief. His final bid was $200.072 million.
The extra $72,000.
Was a coded message.
Yeah.
His lucky number, 72, from his golf score. He was literally incorporating personal omens into multi-billion-dollar deals.
That brings us to the Yahoo deal in 1995, probably the most famous of his early venture moves.
The speed of it is legendary. He met the founders, Jerry Yang and David Filo, and Yang tentatively valued Yahoo at $40 million. Masa instantly agreed, it's a deal.
And Yang immediately regretted underselling his company.
Oh, he thought, oh shit, I should have come in higher. But the real negotiation happened a few months later when Masa came back offering $100 million for a third of the company.
When they stalled, Masa deployed the now infamous kill you ultimatum.
If I don't invest in Yahoo, I will invest in Excite and I will kill you. The threat wasn't physical, of course, but existential. He would fund their most dangerous competitor until they were annihilated. Sequoia's founder told Yang to take the money because Masa might just be crazy enough to do it.
The deal clincher, though, was his demand for control over the Japanese market.
Right. He insisted that Yahoo, Japan, be set up as a condition of the deal, with SoftBank taking 60% equity and providing $2 million in startup costs. That localization strategy was brilliant. Yahoo, Japan became one of his most lucrative and enduring ventures.
But as the dot-com bubble inflated, SoftBank's debt ballooned tenfold by 1996. The catastrophic Kingston technology purchase that highlights Masa's worst tendency.
Overpaying for status and misreading cyclical markets. This was pure hubris. He paid $1.5 billion for 80% of a company with only $186 million in net assets.
Justifying it based on future earnouts.
Even though the memory board market was already collapsing, prices had fallen 75% the year prior. Even his own CFO warned him the deal risked bankrupting SoftBank.
And the result was predictable. He sold the stake back 3 years later for only $450 million. A massive loss.
It illustrates that his genius was often counterbalanced by this fundamental flaw in execution and pacing. But despite the red flags, the euphoria peaked around early 2000. Moss's personal net worth was rising by $6 billion a week.
A week.
He invested over $1.2 billion right at the peak, genuinely convinced everything is cheap right now, whatever the price. His risk appetite was just boundless.
But amid all that recklessness, there was one bet that paid off beyond imagination. Alibaba.
He invested his first $20 million in Jack Ma's company in 1999, solely based on his belief in Ma and the coming explosion of the Chinese internet. That original $20 million stake eventually grew to a peak valuation of $210 billion for SoftBank.
One of the highest returns in venture capital history.
It solidified his legendary status. And it's a perfect illustration of how one single, truly audacious bet can underwrite a decade of expensive mistakes.
And to put that into perspective, Goldman Sachs had invested $3.3 million in Alibaba, and they'd exited 5 years later for a respectable profit.
But they missed out on a final value of $12.5 billion. They sold too soon. A mistake Masa constantly hammered home to his own employees.
And then came the reckoning. March 2000, the Nasdaq crashed.
And it took SoftBank down with it. They suffered a staggering $12.5 billion loss, wiping out 97% of Masa's personal wealth.
Losing almost all your worldly assets. That's an extreme trauma. What was his reaction?
He admitted the loss was devastating, but he claimed he slept well. He focused solely on the long-term vision and what he could control. This is that self-affirming genius's philosophy in action. Failure just bounces off him.
A superhuman capacity to absorb financial trauma without letting it break his conviction about the future.
Yeah, exactly.
So, emerging from the dot-com crater, Masa executed a massive strategic pivot. He stopped focusing purely on content and software and decided to build infrastructure.
Right, adopting the radical mantra that market share and customers mattered more than profitability. The goal was simple. The value was dollars per customer.
This was a necessity. He realized that pure internet companies, especially in Japan, were dependent on the underlying pipes and communication lines.
So his first move was Yahoo, BB, a broadband venture that became his suicide mission because it directly challenged the massive incumbent NTT.
And his specific challenge was forcing access to NTT's dark fiber, those unused communication lines that NTT was deliberately hoarding to stifle competition.
Which led to one of the most incredible stunts in corporate history. In a confrontation with a high-ranking bureaucrat, Masa threatened a public protest, claiming he would set himself on fire if denied access to the lines.
And he used a block of tofu disguised as a bomb to emphasize his point.
Wait, a block of tofu disguised as a bomb?
Yes, it sounds utterly bizarre, but it was his way of injecting immediate high-stakes urgency into a bureaucratic system prone to gridlock.
Was it effective?
It was. A few days later, he received a call. The dark fiber was suddenly available. This defiance earned him the public reputation as the dokigata, the clown or trickster of Japanese corporate life.
An outsider tolerated because he was willing to say and do what the cautious establishment would never dare.
He had proven his disruptive model in broadband. By 2006, he pivoted again, attempting to acquire the poorly run, debt-ridden mobile carrier Vodafone Japan for a massive $17.8 billion.
This deal was financially overwhelming. SoftBank was known as a volatile investment firm, rated BB junk status, to finance this enormous debt load.
In what was dubbed the year of the deal, they needed an investment-grade rating, BBB, to secure the high-yield bond financing required.
How do you bridge that gap? How do you take a junk-rated company and convince the global market it's investment grade based on buying a carrier that was already losing money?
This is where his financial engineers, Rajiv Misra and Kazuhiko Kasai, performed what the sources accurately call financial wizardry. They used a technique called whole company securitization.
Okay, break that down.
So think of it this way. Instead of asking investors to trust volatile SoftBank, the VC firm, they isolated the stable, predictable cash flows from the future mobile revenue stream.
The fixed monthly subscription fees.
Exactly. They essentially ring-fenced the guaranteed payments from the mobile customers and bundled those future payments into bonds. These bonds, secured by predictable customer payments rather than SoftBank's unstable venture portfolio, could then be sold to investors as relatively low-risk debt.
That's how they raised the billions. It was a high-wire act based on projected growth, not their current financial strength. Entirely. But he didn't make this massive leveraged gamble blindly. He had a secret weapon that gave him the absolute confidence to proceed.
And that weapon was Steve Jobs.
Steve Jobs. Massa considered him a true genius, comparing him to Leonardo da Vinci. And crucially, Massa claimed he secured the exclusive Japanese distribution rights for the unreleased iPhone back in 2005,
3 years before the launch?
based purely on Jobs' verbal commitment.
A super confidential promise. That is an incredible amount of faith to place in one man's word.
It was. But this gave him the conviction to take on the massive debt of the Vodafone acquisition. He knew he had a game-changing product in the pipeline. The iPhone deal was instrumental in transforming Vodafone Japan into a massively profitable consumer business and boosting the SoftBank brand from a disruptive outsider to a legitimate major player.
The next major pivot was spurred by the 2011 Fukushima earthquake and nuclear disaster. This event triggered an intense emotional reaction rooted in his outsider's sense of responsibility to Japan.
It was a true turning point. He abruptly proposed stepping down as SoftBank's CEO for a year to focus exclusively on disaster relief and shifting Japan's energy grid to renewables.
And his board was, quite rightly, terrified. Ultra-loyal executives like COO Miyauchi and Uniqlo boss Tadashi Yanai vetoed the resignation.
They argued his primary responsibility was to SoftBank's 20,000 employees. The compromise was they approved a 20 billion yen investment in solar energy, which became the cornerstone of his profitable energy business.
But the brush with catastrophe and the pushback from the establishment only intensified his ultimate ambition.
Which shifted from being a successful venture capitalist to becoming the capital market itself. He resolved that the Vision Fund would be the Rothschild family dynasty of the 21st century.
His stated goals were massive. $1 trillion under management and becoming the richest person in the world.
And he needed capital on an unprecedented scale, which he secured in 2016 by meeting Saudi Deputy Crown Prince Mohammed bin Salman, or MBS, in Tokyo.
The sources note he expertly played on the prince's fear of missing out, the FOMO.
Oh, absolutely. Massa didn't present a standard pitch deck. He presented a world-conquering vision. The result was legendary. MBS approved, in principle, a colossal $45 billion investment in just 45 minutes.
That sum dwarfed any single previous contribution to a VC fund by a factor of 10.
It provided the necessary firepower for the Vision Fund to just completely dominate Silicon Valley.
This infusion of capital led directly to the period of peak hubris, most famously embodied by the WeWork fiasco.
Massa saw the founder, Adam Neumann, as the second coming, comparing him to Elon Musk, Jeff Bezos, and Bill Gates all rolled into one.
The problem was that Massa encouraged Neumann's worst, most reckless instincts. He wasn't a mentor guiding prudence. He was a financier demanding manic growth.
That famous exchange encapsulates the dynamic perfectly. Massa goaded Neumann. In a fight, who wins, the smart guy or the crazy guy?
Neumann answered, crazy guy.
And Massa's reply, you are correct, but you are not crazy enough.
That goading led to an environment of excessive risk and spending, culminating in the collapsed $47 billion deal in 2018.
And the WeWork failure eventually cost SoftBank up to $14 billion. It's a perfect illustration of how Massa's belief in the genius of a founder can become dangerous when you couple it with unlimited capital.
And that ego extended beyond the corporate boardroom.
Yeah.
The sources mention his private life hubris, the multi-million-dollar starter castle he bought in Woodside, California.
It's a staggering anecdote. He acquired this property for $117.5 million, a monumental sum, only to visit it once and stay for a single night.
It wasn't about residence. It was about proving he could buy the biggest, best symbols of wealth and status in Silicon Valley. A pure vanity purchase.
Designed to cement his image as the ultimate big boss. And this Vision Fund war chest and its disruptive tactics where they would overpay startups just to push out rivals, it sparked immediate outrage in Silicon Valley.
It launched a venture capital arms race.
It did. Michael Moritz, the Sequoia VC, circulated an infamous email comparing Massa to Kim Jong-un, stating the Vision Fund's ruthless tactics threatened to obliterate the hard-earned returns of rivals. Massa wasn't just competing, he was redefining the entire venture ecosystem through sheer force of capital.
We need to dive into the financial structure of the Vision Fund because it reveals where the true risk lay. Over half the capital provided by the Saudi and UAE partners was structured as preferred equity.
And this is critical to understanding the pressure Massa was under. Preferred equity is essentially a debt-like instrument. The limited partners, the sovereign wealth funds, were guaranteed a fixed 7% annual return, regardless of the fund's actual performance.
So the Saudis were shielded from the immediate volatility of Massa's high-risk bets.
Correct. They got paid first. SoftBank, the general partner, invested its own money as common equity. This meant SoftBank took 100% of the downside risk.
If the fund performed poorly, Masa's stake suffered first, covering that guaranteed 7% return.
Which meant that Masa was highly leveraged, forcing him to chase these colossal, often ridiculously risky gains just to break even on his own money after paying the LPs their fixed return.
This era of extreme growth faced a sudden, unavoidable halt when geopolitics crashed the party. SoftBank had become dangerously overdependent on China.
Alibaba accounted for a full 50% of SoftBank's market value. And Masa had always operated under the belief that technology transcended politics. He never cared about politics.
But the ascent of Xi Jinping fundamentally changed everything. The Chinese government began asserting much tighter control over its tech giants.
The ultimate collision came with Jack Ma's public critique of Chinese financial regulators in October 2020, where he accused them of having a pawn shop mentality.
That sparked immediate retaliation. The Ant Group IPO was suspended. Alibaba was hit with a massive antitrust fine. The incident cost Ma $37 billion.
And Alibaba's stock plummeted, severely impacting SoftBank's valuation. This finally forced Masa to concede to selling down his prized Alibaba stake, the one investment he had always vowed to keep forever.
It was a major concession to geopolitical reality.
A huge one. And meanwhile, back at home, activist investor Elliott Management bought a $3 billion stake in SoftBank, citing the massive $133 billion conglomerate discount.
Let's clarify that term, the conglomerate discount.
Because SoftBank was this complex holding company-owning stakes in dozens of public and private companies, the market often valued the parent company far below the actual underlying value of its assets. This lack of transparency and complexity creates a discount.
Which Elliott argued was $133 billion. They demanded Masa take action to unlock that value.
And when confronted by Elliott, Masa's ego bristled. He doubled down on his empire-building rhetoric.
He declared, "I am building an empire," comparing himself explicitly to historical figures like Napoleon or Genghis Khan, not to contemporary tech CEOs.
His message was clear. He was not an operator. He was a founder shaping history.
So Elliott pressed for massive stock buybacks to close that discount. Masa responded in the middle of the 2020 COVID crisis by unveiling a $40 billion asset sale and a $24 billion stock buyback package.
The largest ever undertaken in Japan. This was pure Masa. High-stakes defiance. By executing the buybacks during the crisis, he not only placated Elliott, but dramatically increased his own stake in SoftBank from 25% to 30%.
He was still writing history and critically backed himself with his own money.
But the retrenchment didn't last long. With the market surging post-COVID, Masa pivoted yet again, attempting a highly aggressive, high-risk momentum trade in public markets through a subsidiary called North Star.
They focused on the top FAANG's Tencent, Alibaba, plus the U.S. tech giants.
A strategy led by his protege, Akshay Naheda, that involved buying billions in complex derivative instruments called call options.
Which provide massive leverage. They're essentially bets on the price increasing, amplifying both potential gains and losses.
Exactly. And this leveraged betting helped trigger a market melt-up in tech stocks. Companies like Tesla rose 74% in 1 month. But the volatility risked staggering near-term losses. It demonstrated that Masa, despite decades of experience, was still incapable of pacing himself when large amounts of capital were involved.
Yet, amidst all the Vision Fund losses and the North Star debacle, one investment proved exceptionally shrewd and saved his reputation: ARM Holdings.
Purchased in 2016 for $32 billion. At the time, it was criticized as too expensive, too conventional. But ARM's architecture is now utterly central to the entire AI and mobile computing ecosystem.
It was a fantastic long-term play that confounded his critics.
And proved his original instinct on infrastructure was correct. SoftBank recently sought an IPO valuation of $100 billion or more for ARM in 2023.
And this vindication is now fueling his current laser focus: artificial general intelligence, or AGI.
He describes the current environment as the Cambrian explosion of new companies and applications, the decisive moment of the information revolution. He admits his Vision Fund timing was 5 years too early, but he remains utterly convinced his instinct on the ultimate technological direction is still correct.
And his vision for AGI is, well, it's benign, almost utopian.
He believes AI will solve humanity's problems. He urges humans to avoid stupid little fights, stating that the geopolitics of ideology or language or sex, these are small differences between humans. He sees technology as the ultimate unifier.
His final, overriding legacy goal is clear: contributing a foundation stone of AGI so he can pass away with a good smile.
So we've traced the wild ride of Masayoshi-san, a figure of just staggering paradox. He is a master of seduction who inspired immense loyalty and raised capital nobody else could, yet whose hubris led to catastrophic financial errors.
From Kingston to WeWork and North Star. But crucially, he demonstrated immense courage and creative drive, successfully challenging the might of Japan's corporate establishment 3 distinct times. First in software, then in broadband, and finally in mobile. He has come back from the near dead twice.
His story really affirms that world-altering success often requires a level of extreme, possibly self-destructive risk-taking that conventional business leaders simply avoid.
And the final pivot is the most extraordinary. He has moved from building a physical tech ecosystem to aiming for the abstract, creating artificial general intelligence, believing that technological mastery offers a definitive solution to geopolitics and human differences.
He compares himself not to fellow tech moguls, but to empire builders, Napoleon, Genghis Khan.
So considering his laser-like focus on creating artificial superintelligence, or ASI, and his tendency to ignore conventional boundaries, whether they're financial, geographical, or ethical, it raises a truly important question for you, the learner, to consider.
How does the pursuit of technological mastery differ when the ultimate goal is not merely market dominance, but genuinely changing the course of human evolution itself?